Hi, my name is Fabian Dori, CIO of Sygnum. I have the pleasure to welcome you to this live stream to discuss how to navigate current market shifts amid global policy resets. I'm very pleased to run this discussion together with Katalin Tischhauser, Head of Investment Research and both a long-term macro and crypto asset specialist. Please note that all content and opinions presented in this live stream do not constitute investment advice. We will kick off the discussion by putting the current developments into context. Katalin will first relate to the broader perspective, what is actually driving the current developments, and second, assess its impacts on risk assets. I will then briefly dive into the impacts for crypto assets and provide inputs on how to navigate the current situation as a crypto investor. We are looking forward to then cover any inputs and questions from the audience. For that purpose, please make use of the chat function of the comment function to post your questions. For regulatory reasons, we will focus on questions relating to the market conditions only and are not able to address any questions regarding Sygnum or its service offering. With that, and no further ado, happy to hand over to you, Katalin, to kick it off.
Thank you very much, and welcome from me as well. The first point I would like to make is that we are living through the reset of the world economic order and the end of globalization. This is the biggest realignment in the global economic order since the early 1970s. And it's really extraordinary times, and it brings with it extraordinary challenges for investors. A lot of the territory ahead is uncharted. The second point that I want to make is that the US absolutely means it. I think hopes that this is a bluff from Trump are misplaced. He has actually flagged this throughout actually already his campaign as well as since the inauguration. He spoke quite a lot about the golden age of America under President McKinley's protectionist policies. But also, it's not just Trump's personal beliefs, of course. In fact, it's mostly, not that's the least of it, to be honest, it is a necessity. It's a necessity for the United States to make drastic changes. Whether these are the right changes exactly, one can debate, but the need to make drastic changes is definitely there. And which is why I think there is surprisingly little political resistance to these policies. In the US, I think most can see that there is a strong need to do something, and this may be the right thing for the United States. And this is because over the last several decades, the US economy has become hollowed out, deindustrialized, and really, really dependent on China. Now, offshoring US industries, especially to China, this was US policy. This was not, as Trump's rhetoric would have it, the rest of the world taking advantage of America. This was what the US was doing deliberately. And they benefited from it quite a bit for quite a while. But eventually, this policy actually landed the US ultimately in a weak position. And at this point, the objectives are multiple, I think, but I think at this point, the number one objective as the US sees China as a challenge to its hegemony. The number one objective, in my opinion, is to stop the dependence on China. Also for national security reasons, it has already come to that. I think that this will eventually mean that US-China trade can drastically diminish. I think it can come close to even being eliminated. I think this currently sounds almost inconceivable, but I think this is the trajectory which we can see not just from the US's move, but then China's response and the counter move, that this is stopping China dependence is definitely on the cards. It's also another objective is, of course, to rebuild the US industrial capacity. The United States became powerful when it was the world's industrial powerhouse. This is what gave it its power, and that they frittered this away has weakened them, and it made it much more difficult for the United States to maintain its hegemonic position. And I think there may be also an objective to, in a way, kneecap the rest of the world, what Sun Tzu put as burn the world down to rule over the ashes. There could be some of that as well to serve US hegemonic ambitions. Now, the question is, will it work? I think some aspects of it will definitely work, and the global economic slowdown will definitely materialize. I think that's fairly safe bet. And I also think that the US is likely to benefit. Countries that are fundamentally self-sufficient and large can actually benefit from trade wars. Countries that are primarily importers can benefit from trade wars by a surge in the domestic economy. And also we are already seeing trends that companies are relocating to the US as they can stay competitive in that way. Of course, there are tax cuts going through the legislative process in the US, and they're likely to be enacted. That will also be pro-growth. So I think the US eventually is likely to come out of it with a fairly positive growth picture, but with a lag. So there is, of course, an adjustment process when companies relocate. Things don't happen overnight, and the tax cuts haven't even been enacted. So the effect of those will be felt sometime in the future. And of course, the full impact will depend on what other countries do. It will depend on the policy responses of the US government, various governments, the Federal Reserve, other central banks. So it's too soon to assess really how the picture will look. But one thing I would say is that in the US's case, while it does make sense to reshore industry, companies relocating, tax cuts, protectionist policies can actually lead to a domestic revival. But the full policy package doesn't actually include all the elements one would expect to see if really what was primarily endeavored is a domestic revival, which is partly why I think that stopping the China dependence and the geopolitical considerations are more important than the rhetoric, which is to help the American worker and so on. And for example, what I see missing is that investments in infrastructure are not really part of the package, or education. In fact, the education department was just dismantled, and as inefficient as it probably almost certainly was. There isn't really a plan, and this already has been a problem. Just a small anecdote quickly, that when the US encouraged TSMC to locate a chip plant in Arizona, they actually found they didn't have skilled labor, and they had to ship the workers from Taiwan. So there are issues there. But basically, lots of questions still. The full picture is yet to be seen, which brings me to my next point, is the impact on the financial markets. The markets were shocked and surprised. And of course, even though the general thrust had been well flagged, I think the magnitude and the specifics still surprised almost everyone. Especially certain specifics, which countries were affected, to what extent, the formula that was used, that was quite kind of difficult to make sense of. And of course, Antarctica was very hard hit by tariffs, so that was also some aspects of the full picture were certainly very odd. But we have seen financial markets react with increasing risk metrics and uncertainty. The VIX started spiking to levels that were last seen in the wake of the COVID crisis. And actually, we have seen the same also with bonds. The bond volatility index has also been rising sharply. And actually, today especially, but bonds have also become extremely volatile now. There is a tug of war between people thinking that bond yields should rise or what it should fall, based on whether the slowdown in growth is going to be worse or the inflationary effect is going to be worse. And the deliberations are driving bonds up and down, rate cut expectations up and down. Actually, I've been also watching the rate cut probability expectations monitor, and it's like a yo-yo. It's going up, it's going down, it's going up, it's going down. So there's a lot of uncertainty. And this uncertainty will continue for a while. I mean, at this point, there's several layers of it. The first layer is we don't even know how the policies will actually end up. Trump always has a habit, the art of the deal, of going hard and then pulling back somewhat. We could see this, some companies queuing up to, countries queuing up to negotiate, other countries are retaliating. We don't know what the responses and counter responses will be in full. We have to wait for that. Then we have to wait to see what the impact is. And we have to wait to see what the policy responses will be from the various governments and central banks. And like I already mentioned with the bond market and the rate cut expectations, it actually is not clear what the policy responses should be or will be, because unlike COVID, which was recessionary and deflationary with the lockdowns, this is a fundamentally recessionary and inflationary set of factors that put central banks and governments into a much more difficult position. Now, I still expect that expansionary fiscal and monetary policies will prevail, and governments and central banks will be injecting liquidity. Especially because the inflation will be variable depending on whether a country is imposing tariffs or tariffs are imposed on a country. The countries that impose tariffs have the inflationary effect. The countries that don't fight it and don't impose their own tariffs, it's a more clear-cut recessionary, deflationary situation, other than some impact on supply chains and certain price rises, because kind of supply chains get clogged up and need time to be ironed out. So generally in those countries, the policy responses are more obvious. But I think even in the US, eventually we will see expansionary fiscal and monetary policies, either through rate cuts or through stealth QE, or maybe phasing out the QT and maybe even restarting QT eventually, some set of policy responses that will eventually go in that direction would be my expectation. The one thing that, and my expectation is that, because the one thing that we can be fairly certain of is the massive hit to global growth. I think that is definitely incoming, and so the responses on balance are likely to also go in that direction from governments and central banks. In terms of the US, I think things will eventually, it could be a period of adjustment or pain, as Trump calls it, but I think the US will actually come out of this quite well. China will probably cope. China has no choice. The US has chosen this path, and the fact a trade war will be lost by China. That's the setup. However, I think China sees it. I judge that from the retaliatory response and going into this full-on trade war, that they basically see it as inevitable, and they see it as the US has fired the first shot, and this path is now unavoidable. China has also prepared for this. They have stockpiled certain import materials that they need, and they forged other economic relationships over time. So I think they will figure out their own path, but there will definitely be a serious hit. This will be very tough on China. I think it will be the toughest on Europe and the EU specifically, because they not only have they not forged alternative economic paths and trade paths, but burned their alternative bridges, and also haven't prepared with stockpiling in the same way as China has. Ultimately, the impact on financial markets, uncertainty is a clear negative for financial markets. And whilst uncertainty continues, it will be a very difficult situation. And as we get more certainty, things will become clearer, and we see policy responses. And obviously, liquidity injections will support financial markets and risk assets when they come. even if their long-term effect will still be inflationary. So I leave it at that with the macro and hand it over to Fabian to zoom in on the crypto market. What does crypto do in this context?
Many thanks for this broad context and great outline, Katalin. And let me start by reminding our listeners to feel free to post inputs, questions via the comment function for discussion later on. Now, as Katalin put the question, how does the current situation impact crypto asset markets? And is Bitcoin behaving like a risk asset or actually like a safe haven asset? Now, it's true that Bitcoin and the broader crypto market corrected significantly over the last couple of weeks. It is likely that markets went to a certain extent ahead of themselves, following President Trump's very pro-crypto election campaign promises and the surprisingly consistent start to actually implementing them. Now, these excessively positive market expectations and the leveraged positions were to a certain extent recalibrated as practical and political realities kicked in, resulting in the price action that we have seen already ahead of the Liberation Day. Now, interesting though to discuss, I think, is if you look at the performance of major asset classes between the election day last year and in this example, April 7, there are a number of important points worth highlighting. First, both Bitcoin and gold show a positive performance over that window, while equities and commodities perform negatively. You see that in this chart both in the index performance over time, but also in the first performance number at the very right. So despite the positive average correlation between Bitcoin and equity indices such as Nasdaq, as is often highlighted, the absolute performance might differ significantly and was different over that period of time. Second, and Katalin alluded to that before, right? In a situation of sudden uncertainty as caused by the Liberation Day announcement, or by that token also other examples such as the COVID breakout earlier in this decade, the yen carry trade reversal last year, there is hardly any safe haven asset in the short term. Following the tariff announcements on April 2nd, all major asset classes, with the exception of sovereign bonds, reacted negatively. You see the performance of the different asset classes as the second number on the right, showcasing that also gold corrected by about 5% until April 7. The third point, which is interesting, is the fact that most asset classes reacted much more significantly relative to their respective risk profile than Bitcoin did. The number on the very right shows the performance of the different asset classes between April 2nd and 7 relative to their daily standard deviation, so relative to their average risk profile. And what you see is that the negative performance since Liberation Day ranges between 5 to 8 times the daily standard deviations of gold, commodities, and equities. The negative move in Bitcoin was relatively muted by that metrics, with only two daily standard deviations. Now, where are we going from here? As highlighted by Katalin, as long as uncertainty regarding the final outcome of the World Trade Order, its impacts and policy responses prevails, as long as this uncertainty prevails, market will likely remain volatile and susceptible to more drawdowns. However, there are strong indications to believe that the long-term megatrend for crypto assets remains unaffected by the current market volatility. First, fiscal monetary policy responses to inject significant liquidity and to counter the negative economic impacts of the tariffs are very likely and will benefit risk assets in general. Second, the inflationary nature are likely to bring back the focus on Bitcoin's mid and long-term store of value attributes. Bitcoin really derives its value mainly from its store of value use case, being a scarce, verifiable, durable, fungible, portable, etc. asset would make it a very valid candidate as a store of value, and less so as a business side, or less benefiting from business cycle dynamics or from a decentralized application economy. And third, the recent market correction actually drove an additional wedge between prices and the improving fundamentals for crypto assets. Positive fundamentals, such as the regulatory clarity that is advancing in the US, a supportive US administration on the legislative side as well, the progress towards Bitcoin strategic reserves and advancing institutional adoption. Therefore, in a liquidity-induced risk asset recovery, crypto has the potential to be the fastest horse again, with selected altcoins even maybe taking the lead. Now, how to manage this situation as an investor? And here it's worth highlighting that crypto provides a new asset universe rather than an asset class. Investment opportunities in the crypto ecosystem range from market neutral yield strategies over passive and active directional exposure up to alpha strategies. Maintaining exposure to the upside maintaining directional exposure to the upside also through market dislocations has historically rewarded investors with above average returns. As Katalin and I have tried to explain, given the expected liquidity injections and yet to be priced in recent positive fundamental developments, a similar pattern may play out again for crypto assets in the medium term. At the same time, uncertainty will prevail. Asymmetric or risk-controlled exposures may help manage that short-term uncertainties, as volatility and drawdown risk really remains significant for the time being. So strategies to consider in this context are, for example, market neutral yielding strategies, are momentum strategies to capture the upside with limited downside risk, asymmetric positioning through options, or a blended approach of all of it. These strategies are designed to harness potential upside while managing the downside risk. Now, obviously, as always, it's necessary to tailor allocations based on individual risk profiles, on investment horizons, on broader financial goals, etc. But we hope that with this outline, we provided you with additional inputs to assess and navigate the current market conditions. For further details, maybe let's go into potential inputs and questions, and get me to that section. There is one question, Katalin, that I would like to assign to you. The question is, the US administration have said they wanted to see lower bond yields as a lot of government debt is coming up for refinancing. Could they be creating a recession to achieve that?
Gosh, thank you for the question. Very interesting and a very good point. Indeed, Trump, as well as the Treasury Secretary, have stated this on multiple occasions that they want bond yields to be lower. They're more focused on that actually than on rate cuts, despite Trump's tweet the other day in all large caps targeted at Jerome Powell. Indeed, I think, and the issue that the question mentions a lot of government debt coming up for refinancing is indeed a problem. The indebtedness of the US government, and actually most Western governments, is a very serious problem. However, I don't think that the primary motivation for this set of policies is to induce a recession to manage the bond yields. It can be a welcome consequence and side effect, maybe, but I think the primary objective is to stop China dependence. I wouldn't think that it would be the most efficient way of going about this, especially as the country that introduces the tariffs, which is the US, has the inflation to cope with, which actually puts the bond markets in a difficult spot. And we have already seen it. If they expected a rally in bond yields, well, that's not really what we're seeing. There was initially a rally, and then it completely backtracked, and it's up and down. So the bond markets are definitely not looking at this set of policy proposals as, yes, the rally is on. We're definitely, this is all about the recession. The inflationary aspect is quite concerning for the bond markets.
Perfect. Thank you, Katalin. There is a second question. How is all this market uncertainty going to impact institutional crypto adoption overall? for the better or for the worse. Maybe Katalin, I'll kick it off. Please amend with your thoughts. I think that's a very valid question. In general, or broadly speaking, we identified three major use cases for crypto assets. One being crypto assets providing an alternative store of value. Second, providing an alternative means of payment. And third, providing a next generation tech infrastructure and decentralized application economy. Now, I would assume that macroeconomic uncertainty that also impacts the trade order, that might have an impact on the financial infrastructure, etc., is to benefit the first two use cases, that the demand for an alternative store of value, for an alternative means of payment rail is only to increase given the uncertainty that is prevailing, and might see other flavors over the coming days and weeks as well. We also see, so far at least, that the regulation in the US, when it comes to crypto assets, remains very proactive. It's not impacted in any sense by tariff considerations or trade order considerations. So we believe that on that end, that positive element will continue. And again, to conclude a long story, I would assume that the impact on the institutional crypto adoption is rather to the better than to the worse.
Yeah, I would agree, certainly on any kind of at least medium-term horizon. I think, and we've already seen, as Fabian showed it, that even though we're living this close correlation in terms of the margin of the market moves day by day, actually, when we zoom out a little bit over the last few months, crypto correlated positively with gold and negatively with risk assets. That's been the move of the last sort of 3 to 6 months in the financial markets. And because trading happens on the margin, but the sum of the move is actually broader than that. So I think that's definitely supportive for investor adoption. However, there could be kind of short term. We have seen this slowing down for sure, because when investors are maybe panicking is too strong a word, but sort of sell everything. When gold is going down, bonds are going down, everything is going down. That's not the time when let's enter a new asset class kind of conversations even take place, right? So I think there can be sort of a slowdown, which we can see in the inflows, for example, into the Bitcoin ETFs. They have been quite a benchmark of new money coming into the asset class, and those have definitely slowed down. But I think on any medium-term horizon, I would agree with what Fabian said.
Well, thank you for that extension, Katalin. Oh, sorry, there is another question. You mentioned market-neutral crypto strategies, which might have low market risk. But what other risks are associated to that?
Go for it, Fabian.
Good. Let me kick this up. I think first of all, these market-neutral crypto strategies are really an interesting animal, also very much so from a portfolio construction perspective, because their value and risk drivers are quite different than from what you see in traditional fixed income yielding strategies, in the sense that they typically have very low duration risks and very low credit risk in the traditional sense that it would be dependent on business cycle considerations. Now, having said that, there are obviously risks with such market neutral crypto strategies as well. They are, however, different in nature. One key aspect to consider is for sure technological risks. Those strategies deploy capital typically to a certain extent, at least, on decentralized finance platforms through smart contracts. So the question how mature, established, and secure those platforms and smart contracts are is a key question. I would say a second risk dimension is still counterparty risk. Market neutral crypto strategies also beyond deploying capital on decentralized platforms typically use centralized exchanges for part of their investment strategies, for example, funding rate arbitrage or other arbitrage opportunities. And hence, obviously, also have capital deployed on centralized exchanges, which introduces counterparty risks towards those platforms. The question is then maybe more in detail, where is the collateral held? Is it off exchange? Is it on the exchange? That then maybe might mitigate that risk dimension. Maybe a third element is still liquidity risk, right? Can the entered positions be exited with reasonable slippage, with a reasonable market impact, etc.? So I think liquidity risk is to be kept in mind. And maybe also then depending on the domicile, the tax domicile of the investor, potential tax implications that just need to be maybe less an investment risk, but more a risk dimension or consideration to also have in mind when looking at those market neutral crypto strategies. Not sure anything to add, Katalin. Otherwise, I would go ahead.
Do we have more questions?
Right. Let me move to the next one, and thank you really for all those interesting questions and inputs. Thank you for your great presentation. In terms of portfolio positioning, what is your view? Would you rather go for market neutral or rather use options to protect down cap upside? What mix of both?
I wouldn't cap the upside. I would maintain exposure to the upside. I think as we like to say it, in a liquidity-induced recovery with all the crypto fundamentals not priced in that are specific to crypto will be the fastest horse. I would not, definitely not cap or have a sort of fully market neutral position and protecting the downside. I think Fabian, to some extent, went through this before with the prevailing risks is wise.
Just to add that disclaimer again, right? I think it really depends on the personal strategic asset allocation, the risk appetite, the risk capacity, and so on. Just to keep that in mind as well. Yeah.
Yes, we want to say none of this is investment advice, just opinions.
Good. We have covered the existing questions so far. Maybe let's give it a very short period of time to see whether there is any further thought, question, input to come in. If not, and also being mindful of time, let's come to a conclusion and wrap the discussion up. I think we are really, as you cornered it before, Katalin, right, traveling through uncharted, through unprecedented times, which requires a clear focus on risk management that may also offer attractive opportunities going forward. We hope that with this discussion, we were able to provide you with some additional food for thoughts to navigate your crypto investment journey. Let's close the discussion with highlighting again that all content opinions presented in these live streams do not constitute investment advice, and wishing you a continued interesting journey in the crypto asset world. Thank you all and goodbye.